Hey everyone, this is Rob Kientz with Gold Silver Pros with your weekly market wrap-up. This is dated October 7th, 2022. We're going to take a look back at the major economic news for the last week, do a preview for the next week, as well as tell you what's happening in the gold and silver markets. Of course, the main point of news this week, as it always is in the first week of the month, is the payrolls report. The non-farm payrolls came out slightly more positive than experts predicted, lowering the overall unemployment rate down to 3.5%, having payrolls rise by 263,000 as job market stays relatively strong. The non-farm payrolls increased 263,000 for the month, which is above what was expected, but lower than the Dow Jones estimate. Average hourly earnings also rose 5% from a year ago while not keeping up with inflation. That's a better number than what people expected. Leisure and hospitality, healthcare, and business professional services led the sector gainers. The labor force participation rate, however, which is a broader measure of unemployment health in the economy, fell to 62.3%, over 1% below what it was prior to the Great Recession in 2008, 2009. So we have not recovered from that from an unemployment perspective or a non-participatory rate in the economy dating back 13 years. September's payroll figure marked a deceleration from the 350,000 gain in August and tied for the lowest monthly increase since April 2021. According to Charles Schwab, depending on your view of optimism versus pessimism on the economy, there's a little bit of something for everyone in this report. Liz Ann Saunders said, obviously the market is not happy, but the market is not happy in general these days. Her comments meaning that the rest of the economic data has not been strong enough that a relatively mildly positive unemployment report is not going to change that. Stock market futures moved lower after the release while government bond yields rose slightly. So bonds are doing slightly better today, whereas stocks are not doing as well. Also, a little bit of news for you with regard to the OPEC announcement. This week, OPEC announced that they would be cutting production by 2 million barrels a month. According to oilprice.com, the United States is considering response options in relations with its OPEC members and its de facto leader, Saudi Arabia, after the group announced a 2 million barrel per day nominal cut in its collective oil production target earlier this week. U.S. Secretary of State Antony Blinken said, and this is a quote, as to the relationship going forward, we're reviewing a number of response options. We're consulting closely with Congress, Secretary Blinken said at a press conference in Peru late on Thursday. We will not do anything that would infringe on our interests. That's first and foremost, and what will guide us and what will keep all of those interests in mind and consult closely with the relevant stakeholders as we decide on any steps going forward. It's widely expected that the production cut would raise the prices of gasoline heading into what is an election season. The U.S. administration is not particularly happy. Another big point of news is that the Biden administration has released guidance aimed to hobble China's chip industry, as reported by Reuters. New export rules. Reading from the report, the Biden administration on Friday published a sweeping set of export controls, including a measure to cut China off from certain semiconductor chips made anywhere in the world with U.S. tools, vastly expanding its reach in its bid to slow Beijing's technological and military advances. The rules, some of which go into effect immediately, build on restrictions sent in letters earlier this year to top toolmakers KLA Corp, Lam Research Corp, and Applied Materials, effectively requiring them to halt shipments of equipment to wholly Chinese-owned factories producing advanced logic chips. The raft of measures could amount to the biggest shift in U.S. policy towards shipping technology to China since the 1990s. If effective, they could set China's chip manufacturing industry back years by forcing American and foreign companies that use U.S. technology to cut off support from some of China's leading factories and chip designers. That's a Reuters report. There's more in there, but essentially the U.S. is going it alone and cutting off supplies to China for tools needed to create chips, and the U.S. is trying to restart its chip manufacturing industry as well, and to support that on concerns about China controlling that part of the economy. I can't help but think what is going on with some of the world conflicts is also playing into this, trade and other conflicts. Gold and silver are down slightly on the day. At the time I'm reporting this, 1:30 p.m. Central Time on October 7th, 2022. Gold is sitting at $1701.97. It's down about $10 on the day, or down about 0.6%. Silver is also down to 2025. That's at 35 cents off, down 1.71%. All right, now we're going to switch over to looking at the gold and silver market data as we do every week. As you can see on the screen, we're looking at the gold futures volume and open interest as reported by the CME Group, which basically runs the markets. Overall, open interest was down ending the week after a good start to the week beginning, Gold and silver prices had been up dating back to last Thursday on the week in expectations of a negative non-farm payrolls report and maybe potentially negative other economic data factors such as housing prices. While most of that came in slightly better than anticipated, that's caused overall a little bit of selling pressure in gold and silver to end the week. The settlements for gold as of data reported Friday, October 7th, this is the latest data that we have, gold is down $11. On the December contract, the dominant futures contract for gold, there were 86,139 closed contracts so far at a price of 1709.30. Moving over to silver, volume was also down after a strong start to the week, and there has been a little bit of selling pressure on silver as to be expected. Settlements have come in on the December contract as well, which is a dominant contract, down 40 cents today to 20.25 on a volume of 26,000 contracts. Not huge volume, so it's not a huge sell-off in either gold and silver, and I expect going forward gold and silver to remain positive. Going over now to the Commitment of Traders report put out by the CFTC, which is the regulator of the metals trading in the United States. We're going to go down and look at silver, and this is as of September 27th, 2022. So we have the updated report from last week. Remember that the Commitment of Traders report is a backward-looking report. It's about a week to 10 days behind when they publish it, so we don't have the current numbers, but it allows us to look at what happened the week prior. What I always pay attention to in silver are the swap dealers and the managed money, and then I look at other categories like producer merchant and other reportables. You can see those categories up here. This is just a grouping of different positions or groups of positions on the market and what they're doing. The swap dealers or the bullion banks are typically considered the sharps or the smart money. You could basically consider them Vegas in the precious metals markets because they do dominate the trading and have been dominating this for quite some time. So usually they're pretty good at figuring out the direction. That's why we pay attention. As you'll note, the swap dealers are now 16,000 contracts net long when considering both long and short, 43,959 total long on silver, 27,280 total short on silver. Net have removed 1,600 long contracts and dropped 784 short to a weekly net short move of about 900 contracts. Not much. They're still net long. The managed money, which is typically the other side of the bullion banks and represents the financial trading houses on the market, most of which do not specialize in gold and silver, but really specialize in stocks and bonds and other things, are net short on silver to the tune of about 8,000 contracts. They're short 42,522 contracts as of the latest COT report, and long 34,429. Again, that indicates to me that silver is most likely to move up in the short to medium term because the managed money usually takes the opposite side of the trade than the bullion banks, and is typically not considered the smart money there, although they are considered smart money in other places. Other reportables continue to get really strong in favor of silver, net moving about 2,400 contracts to the long side, and the producer merchants are almost always short because most of it are the mining producers hedging their downside short risk, so they'll take short contracts on the market. Moving over to gold, a different situation. The bullion banks, or the smart money that I consider, are net long about 50,000 contracts in gold. However, they have moved to a more long position net by about 8,300 contracts for the week. So they've dropped 8,900 shorts and they've added 688 longs for a net repositioning long of about 8,300 contracts. So it's very clear that the bullion banks and swap dealers in gold in the last few months are moving long on the derivative markets. Producer merchants are predictably short as they're hedging their downside price risk. The managed money is short now in gold to the tune of 117,265 contracts against longs of 74,171. The managed money clearly expects gold to move down and have bet that way, and they have dropped 4,300 of the long contracts and moved more short, an additional 2,000 for a net move of 6,000 short on gold. The other reportables, which are the rich family offices and rich individuals, wealthy individuals, are net long on gold, 132,983 contracts to the short of 37,808, so about 95,000 contracts to the long side. The other reportables clearly expect the price of gold to go up. Moving over to Comex Depository Warehouse Gold Stocks, this is where we track the physical. Two categories here, as we always report. There's eligible and registered. The eligible, as depicted in light green on the chart that you see on your screen, is the private storage. The CME Group has admitted they don't know how much of this could move back into the tradable market on Comex. It could be as little as 50% in a letter dated April 19, 2020. However, we're going to continue to monitor that. We don't think most of the eligible will come back into the market at these depressed prices, but they could at some point in the future. So for the most part, we track the dark green line, which is registered stocks, which is the liquid gold and silver available on the market. Looking at gold here, we have registered stocks at 13 million ounces. That's down and has been moving down since May of this year, as gold is slowly being run off the Comex market, although overall gold stocks are still considered pretty healthy. Moving over to silver, a little bit of a different situation. Same dynamic. The eligible stocks are private storage. Registered stocks are the tradable liquid silver. The tradable liquid silver has dropped from about 170 million ounces to about 40 million ounces in about a year and 7 or 8 months. As we move closer to the end of the year, I expect the stocks of eligible tradable silver on Comex to continue to fall, creating a potential shortage situation heading into 2023. Relative shortage now may be an absolute shortage if the markets are continuing to drain and additional stockpiles are not being found. I will note that the Silver Institute has noted that for the last 3 years prior to 2022, the miners have not put out enough silver to refill all the demand from the market, both investment and industrial, over the last 3 years. And they projected out in 2022 for about 110 to 120 million ounce shortfall for this year. So far, it seems to be keeping pace with that. So we know at this point, essentially, silver is being used much more than it's being produced. And given the fact it can take 2 to 7 years to bring additional mining supply online, appears to be setting up for some sort of silver short physical condition moving forward. We'll have to follow that as those developments occur. Also wanted to point out that the LBMA has seen a 3.6% decrease of silver from the previous month, which is now valued at 16.4 billion, which equates to approximately 950,208 silver bars. This is for the London market. This is the other half of the big Western market availability of silver. This is the lowest amount of silver held in the vault since reporting started in July of 2016. Again, the lowest amount of silver in the London vaults in the last 5 years since it was reported, the lowest ever reported number. In addition, to put it in context, the London vaults lost 45,166,000 troy ounces, which is more than the entire registered category in Comex of 40 million ounces. So London has lost more silver in the last few months than Comex has available for trade, meaning we don't expect Comex to be able to cover for London or vice versa. They're being run off of the markets in total. This has been your weekly market wrap for October 7th, 2022. This has been your host, Robert Kientz from Gold Silver Pros. Stay tuned next week where we'll do this all over again.